Welcome to this deep dive from Talk Tickers, where we cut through the noise of earnings calls to bring you the essential insights.
Our mission today, helping you quickly grasp the key takeaways from Boot Barn Holdings, Inc.'s third quarter fiscal 2025 report.
And they certainly gave us a lot to talk about. Management seemed quite pleased.
Yes, they used phrases like very pleased and talked about broad-based growth. Let's get into those headline numbers.
Okay, first up, total revenue. It jumped 17% year over year. Came in at $680 million.
That's a big number. And crucially, it wasn't just from new stores. Consolidated same-store sales grew a really robust 8.6%.
Wow, 8.6%. And that was strong both ways, stores and online.
Yep, stores were up 8.2%, and e-commerce did even better, up 11.1%. So growth across the board there.
Okay, so sales are strong. What about profitability? Did that follow?
It did. Merchandise margin expanded by 130 basis points. So, 1.3 percentage point improvement on the profit from the goods they sold.
Nice. And that flowed through to the bottom line.
Absolutely. Earnings per diluted share hit $2.43. That compares to just $1.81 in the same quarter last year.
$2.43. Hang on, wasn't their guidance lower?
Much lower. That $2.43 was a full $1.36 above the high end of their own forecast. That's a significant beat.
Okay, but wasn't there something unusual in that number?
Good point. They did call out an approximately 0.22 benefit related to the CEO transition that happened during the quarter. Think of it like a one-off item.
Right, related to the departure agreement or something. So factoring that out, still very strong operational performance, especially during the holidays.
Exactly. It shows significant momentum and solid execution. And management pointed to a few key strategic initiatives driving this. First up, expanding their store base.
Yeah, they're definitely not slowing down on physical stores. They opened 13 new ones just in Q3.
Bringing the year-to-date total to 39. And they're sticking to their target of 60 new stores for the full fiscal year.
60 stores, that's what, 15% unit growth? That's aggressive?
It is. They ended the quarter with 438 stores in 46 states. And they mentioned planned Q4 openings in Alaska, Vermont, and Rhode Island.
So soon they'll be in 49 states, almost everywhere.
And the economics seem to work. They keep citing this model. $3 million expected revenue in year one for a new store, delivering roughly a 60% cash-on-cash return.
60% return in the first year is pretty compelling for sticking with brick and mortar.
Right. And they even talked about the potential to double their current U.S. store count over the next few years. They see a long runway.
Okay, so store expansion is one pillar. What about driving sales in the existing stores? That 8.6% comp.
Let's break that down. The store-specific comp was 8.2%. They said that was driven by a solid 6% increase in transactions.
So more people coming in?
Exactly. And a 2% increase in units per transaction, or UPT. So people are buying slightly more items when they visit.
Makes sense. Which categories were strongest?
Pretty broad strength, actually. Positive comps across all major categories. Right. Standouts were ladies' Western boots and apparel low double digits. Men's Western boots and apparel were also strong, high single digits. Denim, low double digits again. Work boots and apparel were positive too, but more low single-digit growth there.
And getting all that done, especially during the holidays, sounds like an operational challenge.
For sure. They credited their field teams, smooth inventory flow from the DCs to the stores, getting holiday floor sets ready early, having inventory available.
And they hired a lot of seasonal help too, right?
Over 5,000 seasonal associates, yeah. Plus, their marketing seems to be working, expanding awareness, tailored ads across radio, direct mail, digital, even connected TV, and artist collaborations.
That loyalty program growth seems to reflect that engagement. 9.4 million active customers.
Up 15% year over year. That's a valuable base to work with.
Okay, initiative 3, omnichannel. E-commerce was strong too.
Very strong. That 11.1% comp growth in Q3. And what's interesting is how they're linking it to the stores.
You mean shipping from stores?
Exactly. They said about half their online orders between Black Friday and Christmas ship directly from a store. It helps manage inventory and speeds things up.
That makes sense. And they just hired a new digital lead.
Yeah, a new chief digital officer, John Kosoff. Comes with experience from places like Tilly's and Taco Bell, so it signals they're serious about pushing digital further.
Okay, 4th initiative, margin expansion and exclusive brands. We touched on the 130 basis point gain. What drove that?
3 main things. Supply chain efficiencies, better buying power as they scale up, and the big one, growth in their exclusive brand penetration.
Right, how much did that grow?
It was up 180 basis points in Q3, and that's on top of a 310 basis point increase the year before.
Wow, so that's really compounding. They're leaning hard into their own brands.
Definitely. And management sounds confident these factors will keep driving merchandise margin higher. It's a key part of their profit outlook.
They also gave a little preview of Q4, right? How did January look?
Yeah, the first 4 weeks of fiscal January, as I said, the broad-based growth continued. Consolidated same-store sales were up 8.3%.
Still strong then. How did that break down?
Stores up 7.2%, and e-commerce actually accelerated to 17.1% growth in January.
17% online. Okay, so momentum is definitely carrying over.
Management seemed to feel good about the tone of the business. They also noted the Easter shift into next fiscal year isn't really a big factor for them, which is helpful context.
Good to know. Okay, let's dig into some more of the financial details beyond the headline numbers. Gross profit dollars.
Q3 gross profit was $239 million, up 20% from last year. That's 39.3% of sales, compared to 38.3% last year.
So the rate improved 100 basis points or 1 percentage point. How did that reconcile with the 130 basis point merch margin gain?
Good question. That 130 basis point gain was partially offset by 30 basis points of deleverage in buying, occupancy, and distribution center costs. Basically, costs related to new stores and running the DCs grew a bit faster than sales in that specific period.
Got it. What about operating expenses, SG&A?
SG&A was $139 million, or 22.9% of sales. That's actually down as a percentage of sales from 23.8% last year.
Lower operating costs as a percent of sales. How did they manage that?
Well, it was mostly due to that one-time item again, the forfeiture of incentive compensation linked to the CEO transition. That gave them a $6.7 million pre-tax benefit in Q3. Made the SG&A look artificially low for the quarter.
Oh, right. So not really sustainable leverage, more of a one-off.
Exactly. Putting it together, income from operations was $99 million, or 16.4% of sales. That's up nicely from $75 million, or 14.4% last year.
And the balance sheet looked healthy?
Very. Inventories was up 23% year over year to $690 million, but that includes all the new stores. On a same-store basis, inventory was only up about 1%.
So pretty well managed, it seems.
Seems so. And they ended the quarter with $153 million in cash, and importantly, nothing drawn on their $250 million credit line. Lots of flexibility there.
Given all that strength, it's no surprise they raised their full-year outlook. What's the new guidance look like?
Let's look at the high end. They now expect total sales around $1.92 billion for the full year. That's 15% growth over last year.
15% growth in same-store sales.
Now expecting 5.9% consolidated for the year. That breaks down to 5.4% for stores and a pretty punchy 10.2% now expected for e-commerce.
10% online growth for the year. Okay, gross profit.
Guided to $716 million, roughly 37.4% of sales. That implies a 110 basis point merchandise margin increase for the full year, and they explicitly said 100 basis points of that comes from exclusive brand growth.
So exclusive brands are really carrying the margin story this year.
Big time. Income from operations now guided to $241 million, or 12.6% of sales.
Net income expected around $182 million.
Yep, representing 24% growth over fiscal 2024.
And the bottom line, EPS.
Raised significantly.
Yep.
Now expecting $5.90 per share, up 0.30 cents from their previous guidance of $5.60.
Yes, funding those 60 new stores they still plan to open this year, hitting that 15% unit growth.
Okay, so a strong full-year outlook. What about just Q4, the current quarter? They guided Q4 sales to $460 million at the high end.
And same-store sales for Q4?
Expected to be up 7.8% consolidated. That's 7.2% for stores, and continued strong e-commerce at 12.1%.
Okay, still very healthy growth. Gross profit for Q4?
Expected around $168 million, or 36.5% of sales. That reflects another estimated 120 basis point merchandise margin gain, again partly offset by about 60 basis points of deleverage from buying, occupancy, and DC costs. Similar story to Q3.
And operating income and EPS for Q4?
Income from operations guided to $51 million, or 11.2% of sales. EPS expected at $1.26, with a tax rate around 25.4%.
Interesting that the Q4 comp guide of 7.8% is slightly below the Q3 actual, even with that hot January start.
Yeah, and they mentioned that, attributed to just historical seasonality patterns and facing tougher comparisons in March. But still, a strong guide building on a strong prior year.
Right. Now, the Q&A session often brings out some extra color. What were some key themes there?
Definitely. First, they doubled down on the January strength, specifically mentioning an acceleration in men's and women's Western categories compared to Q3. They don't see the positive tone changing.
What about looking further out, like next year's comps? Any hints?
They basically said their historical low to mid single-digit comp is the starting point for budgeting, but it's way too early for any specific fiscal 26 guidance.
Makes sense. What about the drivers for merchandise margin beyond this year? Is that sustainable?
That was a big topic. They reiterated the Q4 drivers supply chain scale and another 200 BPs expected from exclusive brand penetration just in Q4.
But can the supply chain gains continue at this pace?
No, they were pretty clear on that. The big 70 basis point gain this year from renegotiated rates and DC leverage is mostly done. Maybe only 10 basis points next year from that.
So where does future margin expansion come from?
They're banking on roughly 30-40 basis points annually over the next, say, 5 years. Primarily driven by continued exclusive brand penetration growth, maybe 200 basis points a year on average, plus ongoing benefits from buying scale and vendor discounts. They seem confident vendors will keep cooperating.
Inventory management seemed like a key theme, too. They sound happy with where levels are.
Yeah, very happy. Remember, only up 1% on a same-store basis. And importantly, markdown inventory is lower than last year, and even pre-COVID. Suggests clean inventory, not much fashion risk.
And they credited that holiday execution, right? Having stuff ready early.
Exactly. Inventory planning, floor sets ready. They plan to stick with that discipline.
Did they elaborate more on the supply chain wins?
Just mentioned renegotiating logistics rates and better utilizing their Kansas City and Fontana DCs. They'll keep looking for efficiencies, but acknowledge the pace of improvement will slow down.
Were there any areas they admitted needed work?
Yes, they specifically called out work boots. They want to see better performance there, focusing on their own brands like Hawks and Cody James, and looking at specific product types like lace-up versus pull-on boots.
Interesting. And how do they feel about comping these really strong results next year?
Confident. They expect momentum to continue in hot categories like denim and men's western. Plus, they noted the ladies' business will face easier comparisons early next year, which should help.
What about tariffs? That's always a concern, especially with Mexico.
Yeah, they detailed their exposure. 30% of orders from China, rubber boots, apparel, and 25% from Mexico, mostly those core leather-soled cowboy boots.
So a quarter of their business potentially exposed to Mexico tariffs. What's the plan?
They're testing other countries, but not panicking. Plan A is negotiating with vendors using their scale. Plan B might involve passing price increases to, well, you, the customer. They did say handling a 10% tariff is much easier than something higher.
Makes sense. What about jamming more stores into markets? Cannibalization?
They said density depends on the market. In places like Houston, Dallas, Southern California, Phoenix, stores within 10 miles can work well.
And they factor cannibalization into the plan.
Yes, it's in their models.
Yeah.
But interestingly, they said they've actually seen less impact than they expected.
And the new stores are performing well.
Very well. Opening at higher volumes over $3 million versus $1.7 million historically, and maturing faster, beating the chain average comp in years 2 and 3. Stores opened 68 years ago have apparently doubled their sales volume.
Wow. Are they taking share, or is the market just growing?
They think both. Taking share from local competitors, but also getting existing customers to buy more.
Any big shifts planned for product assortment? More fashion?
It seems like they're sticking to their knitting. Happy with the core assortment, main focus is improving those work boots.
Did they mention maybe broadening the appeal slightly?
Just a little. Maybe adding things like baseball hats or different denim styles to attract the just country customer, slightly expanding their addressable market. Small tweaks, not a major shift.
What about private label opportunities within men's and work?
Yeah, they talked about Hawks and Cody James again. Hawks, being newer and including those lace-up work boots, is seen as having more upside, especially in that work boot category they're targeting.
Looking ahead to next year's SG&A, any levers for improvement?
Still early days for FY26 guidance, but potential positives include HQ lease costs flattening out, maybe incentive comp being less of a headwind than this year overall, and a legal charge from this year not repeating.
But they'll still have costs for new stores.
Oh yeah, they plan 65, 70 new stores next year. So that requires more field staff, support staff, normal growth investments.
What's driving the actual customer transaction growth? That's 6%.
They said it's been incredibly consistent across all customer types: Western, work, fashion, country, and income levels.
So broad-based demand.
Right. They credited the merchandising team for having that good, better, best assortment that appeals widely.
And e-commerce accelerating.
Yeah.
What's the main driver there? Traffic.
Primarily traffic to babarn.com. Yeah, that's over 75% of their e-com business. Conversion rates are apparently steady, so it's mostly about getting more eyeballs.
How are they getting that traffic?
They mentioned things like store locator page visits, over 1 million in Q3, showing the online-offline link. Also success with Google tools like PMax, finding new customers, profitably maintaining over a 4x return on ad spend.
And their overall marketing strategy, still focused on brand building.
Yeah, not super promotional. Leaning into connected TV, artist collaborations, they mentioned names like Jelly Roll, Morgan Wallen, Miranda Lambert. Still using radio, but liking CTV for new markets. Focus now is prepping for key seasons like rodeo.
Okay, lots of detail there. Now let's switch gears for a moment. Time for our This Is Not Financial Advice segment. Remember, folks, this is purely speculative, for illustration only. Don't try this at home without talking to a pro.
Absolutely. Just thinking creatively based on what we heard.
Okay.
Idea 1. Let's call it the physical retail defiance play.
Intriguing. What's the trade?
Go long Boot Barn Holdings. Short, a struggling traditional mall-based apparel retailer.
Okay, the logic.
The pitch is that Boot Barn is actively, successfully growing physical stores with strong returns and minimal cannibalization, defying the broader retail gloom. They have a niche, loyal base. You're betting their specific execution and expansion runway overcome general retail pessimism, while the short benefits from ongoing mall traffic woes for a less differentiated player.
Patting on the outlier, essentially. Okay, idea 2.
The tariff supply chain arbitrage. This one's a pair trade too. Short Boot Barn, go long appear in apparel or footwear with little or no Mexico supply chain exposure.
Focusing on that tariff risk we discussed.
Exactly. Despite management's confidence, if significant Mexico tariffs hit, it could disproportionately impact their core cowboy boot business, 25% of orders. This could squeeze margins or volume more than expected.
So the trade assumes tariffs hit them harder than a competitor without that specific Mexico risk.
Precisely. You're betting the specific geopolitical risk materializes and impacts Boot Barn negatively relative to a peer that's insulated from it. It's a specific risk hedge or relative value play.
Got it. Again, purely speculative ideas there. Okay, let's wrap up this deep dive. Boot Barn Holdings, strong Q3 beat.
Definitely. Broad-based growth channels, categories, geographies, they raise the full-year guidance significantly.
Driven by solid execution, those strategic initiatives like new stores performing well, strong same-store sales from transactions and inventory control.
And continued merchandise margin gains, largely thanks to supply chain work, scale, and especially those exclusive brands.
Key themes from the call included confidence in future growth, managing inventory well, acknowledging areas like work boots need focus, navigating potential tariffs, and the success of that new store model.
We covered a lot, hoping to give you a comprehensive overview of the quarter and what management is thinking about.
And one last time, those trade ideas, purely illustrative fun, not financial advice for you. Please consult a qualified professional before making any investment decisions.
We hope this deep dive has given you a clearer picture of Boot Barn's performance and where they might be heading.